Welcome back. In this video, we are going to look at momentum or the rate of change oscillator. The term momentum oscillator and rate of change oscillator are synonymous. Rate of change is often abbreviated as ROC. The ROC oscillator is calculated by taking the most recent closing price and subtracting the closing price from a set number of days in the past. We multiply this difference to 100 in order to calculate the momentum oscillator. So here is the formula for momentum oscillator. Here M stands for momentum oscillator value, V is the last closing price or the latest closing price, and Vx is the closing price from X days ago. When you construct the oscillator using this formula and plot the data, you see that as the ROC oscillator crosses 0 in the same direction as the direction of the trend, this movement is considered a buy or sell signal. For example, in an uptrend, if the ROC oscillator crosses from below 0 territory to above 0 territory, it's a buy signal. Alternatively, if prices are in a downtrend and the oscillator crosses from the above 0 territory to the below 0 territory, this would be a sell signal. You should ignore crossovers that happen opposite to the trend because you should always take into account the general trend when using oscillators. This same oscillator can be constructed in a way that it oscillates above and below 100. Here is the formula to design the oscillator such that it oscillates above and below 100. This oscillator is calculated by dividing the latest closing price of the security by the closing price of the security from X days ago and multiplying this to 100. This is just another way to construct the oscillator. The basic interpretation stays the same, only the calculations would have changed. Let's look at an example to understand how we can use oscillators. Here is the chart of an emerging market stock index, and although it is not shown here, this momentum oscillator moves around 0. The oscillator is actually moving between the values of plus 10 and minus 10. In the month of February, this market made a new high and entered a period of correction. This market then made a bottom sometime in February and rallied to a new high in March. Now if you were to look at the price made a new high, and this line here signals that the prices were able to make a new high. But now look at the oscillator. The oscillator failed to make a new high when the prices made a new high. So if we connect the oscillator values around these two highs, we get a downward sloping line. However, if we connect the price highs, we get an upward sloping line. This here is the concept of divergence. A divergence happens when only either the price or the oscillator is able to make a new high or a new low. So for example, if prices have made a new high, ideally what should happen is that oscillator should also make a new high. Similarly, if prices make a new low, then the oscillator should also make a new low. If this happens, we say that both prices and oscillators are converging. Whenever this does not happen, we say that there is a divergence between price and oscillator. This implies that this recent high or low is not sustainable. So here we see that the prices made a new high while the oscillator did not make a new high. This implies that the prices are not sustainable, and what happened is, as you see, the prices reversed substantially. Here you see another example of divergence. You see here that the prices here were able to make new lows, but the oscillator failed to make new lows. The result was again the same. The prices were unable to sustain these new lows for long, and the prices reversed considerably. Here is another example of divergence where prices made new highs, but the oscillator failed to make new highs. Here too the result was a change in trend. As a trader, you should realize that a divergence in itself is not an actionable indication, and so as a trader, you should look for further indication of a trend's end before acting. So for example, if you notice a divergence and that the trend had been following a trend line, now suppose you see a break of the trend line, then you have got your confirmation signal on break of the trend line, and only when you get such a confirmation, you may take a trade in the market. With this, we have come to the end of our discussion on momentum oscillators.